Good morning, ladies and gentlemen. Well, in terms of risk, last week showed absolutely no change. We're still at 32. If we look at where we have been, we've been nowhere. We've been at 32 for such a long time. There's no increase in risk, there's no decrease in risk, which is slightly puzzling because the market is quite strong. Just a continuation of a relatively weak trend. No change, and I don't see any change by year end. The market seems to be pretty much stuck, going towards the upper end of deviations. What are deviations telling us? Well, they're telling us that maybe we have room up towards 3200, but you will see the Bollingers for the monthly and the weekly preclude that. The monthly Bollinger especially, really 3180 is about as high as is sustainable. Everything else is likely to be retraced at one point or another. So the Santa rally is going to be quite weak. Really the most important sectors are going to be still to follow what XLK is saying. XLK has a little bit of room further towards 9060. Very much doubt that it can go anywhere above there. XLF is now in a consolidation phase, having done a pretty strong leg up as we forecast, and we took quite a bit of profit. So now really sideways before the final burst up, I would have thought, and that actually is very much what also the yield curve is saying. The yield curve keeps on trying to steepen and then gives it all back, tries to steepen, gives it all back. It's going to take patience with the yield curve. It's not going to be a quick process. Still QE in Europe, still a lot of liquidity about. The central banks are providing it and people are just reaching for yield wherever they can. XLV, I think now at some stage is going to correct back, but that's just my particular bias. XLP just, very stable at higher levels. I think you're not going to see very much out of that until the end of the year. And XLY just needs some time to coil in here before it starts going up and taking out the highs over here. This is the sector that next year has to lead. If this sector doesn't lead next year, I think slim pickings for the S&P, but I would expect a break higher. Finally, XLI, it just can't get going with us because of the strong dollar and the continuation of, the dollar does the same thing as the yield curve. It keeps on trying to break, fails, keeps on trying to break, fails, until the dollar can get significantly weaker. I don't expect XLY to be able to sustain a strong trend. The one that we got out of on Friday is quite a bit of IWM, but especially got out of all of EEM. Up here, I think EEM is more likely to consolidate and come back and then try to break through the 45 level. The 45.05 level, I consider extremely important. The Blue Angels basically are saying that we are very, very close. I mean, the market very rarely jumps more than one Blue Angel at a time before consolidating. And that is what we are seeing at the moment. Very close to 3200 is the times 18. After that, I would expect quite a period of time in the, between times 18 and times 17.5 before the market can turn these Blue Angels. Time is needed and go higher. That's why I suspect that Santa is not really going to bring much reward to the S&P over the next couple of weeks. No change at all in bond land. Every time the market goes and tries the higher yields, you get smacked back, both in Europe, but also in the US. No change at all in the 2-year. We have the levels. I've written them down in last week's bias sheet, and I will reiterated again at the end. Minus 71 in the 2-year. In the 5-year, we have in Europe we have the minus 52 level. He got there, boom, straight back, and I think we'll probably trade minus 61 over the course of this next coming week. And in the Bund, I mean, minus 22, minus 21, minus 22 is the level, and basically after that the market just sort of fades back, because QE, you have so much buying by the ECB, and that's not going to stop anytime soon, and therefore it's unlikely that the Bund can go and make a lot more headway until there's very strong empirical evidence of a pickup in Europe. But also the 10-year is very much the same. We need empirical evidence of pickup in the States. What a familiar chart, right? The fives. We have the level pat, 177 to 187. Anytime it gets anywhere there, you just go berserk and you look for lower yields. Nothing at all is going to happen there. It's going to be in a 15 basis point range for many weeks. If we look at the 10-year, this to me still looks that eventually it'll break up. But for the time being, and the fact that the Bunds can't do it, well, that means that the 10-year can't either, because the Bunds and the 10-year are very much tied at the moment. Every time there's any kind of move in the forwards in foreign exchange, people come in and buy the 10-year because they can finally get some sort of a pickup. So unlikely to happen anytime soon, and therefore minus 70 will probably be seen at some stage before it starts going up again. But I'm happy holding a medium to long term view and position that the yield curve eventually will steepen. Gold is a very good indicator of what's going to happen to bond yields, and the fact that it refuses to break 1457 tells me that bond yields are not going to scream higher anytime soon. In fact, the continuation of this chop around 1500 to 1457 is the most likely thing. This is what is absolutely stopping me from going in all out on a steeper yield curve, as I said last week. Until this breaks, not a lot of point, and it looks to me like it's going to go towards 1500 next week rather than where I wanted to go, and that is towards this 1300 level. I think we will see it next year at some stage, but at the moment there's absolutely no point in increasing positions and going in all in, because it's just not going to happen. I think it's 1520 is more likely than even a couple of bucks below 1457. Well, the Dixie actually, for the first time in many weeks, is developing a structure. So it's trading below the 50, it's trading below the 200, it's holding on for dear life to this kind of uptrend line. I think the most likely thing is that it comes back towards 97.87, and that is going to be the test. If you cannot close, say, even a week above 97.87, I think that will give time for these moving averages to flatten out and finally for the market to start going lower. I think there's a big likelihood over the course of, say, January, that we have a big month in the Dixie lower. But that's just a guess for the time being. I think all of these need to correct. 97.87, I think, next spot, and the spot where I'm interested in doing something towards the downside. And if that doesn't work, I'm really giving up with the dollar for a long time. Monthly SPX 3180 is the level in the Bollinger Bands. The market hardly ever closes above the Bollinger Bands, or at least does not retrace. So we tried 3180.85 on Friday with all the excitement. Didn't work, closed back below it. I don't think it'll work on Monday. I don't think it'll work on Tuesday. I think 3180 is a very good level to be completely out and looking at some stage to re-enter on this monthly red line, which at the moment is 2990. Next month it'll be just over 3000. Do I think we will see it? Yes, I do, because I think this trend will persist, but it'll be a shallow trend in terms of retracements and in terms of crawling up this very not very sharp uptrend line of the Bollingers. Eventually will explode, but it's very visible here. 3015 to 3190, that's your range. I don't think we'll be lucky to see 3015 again, but there again, you never know. If you have a look at the dailies, don't have any real structure. The Bollinger Bands are all here, bunched around in a percentage point. So at some stage it's more likely to come and test these levels around the 3130 than keep on banging its head up there. It will do so, but then in one day it'll give it all back and come down towards these levels just around the around the 3100 to 3125. It's unnatural that the market can break the times 18 Blue Angel, the monthly, weekly, daily Bollingers without some shakeout in the weeks ahead. And I know that we are coming up to Santa rally time, but I think this year it's really not going to be very strong. To me, volatility is a much better short than the S&P is a long. I don't know what people are thinking about up here. Great sell, thank you very much, and we filled all the gaps here, so now we can fill this one here, basically down to below 12. That's another 100 points on the downside, which it's not surprising to see next week, while the market trades in a 3150, 3190 kind of range, and then we can probably go up a little bit towards that, the middle here. But what is that, 13.5, something like that. At some stage over the next week, while the market is still in a trading mood, I fully expect this gap to be closed. The one I think for next year that we have to really keep an eye out on is EEM. Here you have the daily and the weekly. You can see how close we got on Friday to this all-important 45.05 level. I always leave a tip for the dealer, so I'm quite happy to have been filled at 80 and 90. This market is, to me, ready for some sort of a violent breakout. It could be that we come back all the way down to 43 and then go again. You can see how it's not quite ready yet. A few more weeks of sideways before it starts going up. To me, this could really be the big one for next year. I think multiple expansion can only take you so far when you are trading at 18 forward earnings. Even if the economy improves, well, the US economy was always good. If the world economy now improves, how much more can that help the US as opposed to countries which have been beaten down? To me, this is the logical one. The yields, how much lower can the yields go in the States when you have so much issuance and you have such a flat yield curve? I just don't see the S&Ps being able to keep pace with something like EEM next year. I don't really have very much to change for the biases for the for the 8th. We can put down the 15th and say we've done our job, because the levels are perfect. The 2-year, the 5-year in Germany, the 5-year in the States, the yield curve, is saying not yet, it's not going to happen yet. The bobble and the Bund, those levels are just perfect. So at those levels you get long and you look for a rally of 100 points in the Bund, 50 points in the bobble. You're looking for 10 to 15 basis points in 2s and 5s, and that's it. That's all you have to look for. While that is going on and volatility is such a sell, I just can't see the S&P going down, below 31.15, and 31.80, as I've showed you for a variety of reasons, is a very good level not to be involved anymore. European equities, they're doing nothing wrong, but I would prefer, while the dollar trade to me looks more convincing at 97.90 than any other level before that. And EEM, while EEM is taking profits, it's hard to see the S&Ps do too well. Therefore, this is what I said last week, in the past several weeks. 42-ish is the level to buy. That's where he got to. 45 is the level to sell. That's where he nearly got to. 10, less than 10 ticks. So now I would have thought between 43, 40, and 40 and 44 is the level to look for EM. Thank you very much indeed, and tweet you on Monday.